Good morning, everyone. This is Dan Henn coming from a nice, bright, and sunny Rockledge, Florida today. Let me know that you can hear me by telling me where you are located and what's the weather like in your neck of the woods. And we'll get started here in just a minute. Okay, thank you guys. Gina from a cloudy Georgia, cloudy but hot Georgia. Christine from Seattle, gray, which I actually kind of half expected that response. I'm assuming you're not as hot as the rest of the country is. Jacqueline in Houston says it's hot. Ben in Arvada, Colorado says 95 degrees today, but cool right now. Yep, we're supposed to get pretty hot today too, but not as, I'm actually getting on an airplane today to go to Phoenix to see my wife and daughter out there. My daughter is going to school out there. It's supposed to be 110 today in Phoenix. So Karen in Kansas, 78. Well, you're probably one of the few, I guess, not going to get too hot. Okay, guys. Well, let's go ahead and get started. My name is Dan Henn. I'm a CPA in Rockledge, Florida, in the area known as the Space Coast. You are here to learn about statute of limitations basics, more directly how it relates into collections. We do talk a little bit of how these play into the exam side of things, and we're going to get started here. So you make sure that you are logged in on the computer for the full 50 minutes. You must answer 3 of the 4 polling questions that I will put on the screen. And if once you've met those 2 requirements, then certificates will be emailed generally within about a week. We've been running a little bit behind recently, but and then we report to the IRS once a month at the end of the month for all the CPE we've done for that month. You can go to the handout pane for the handout with the slides. The very last slide should be in the handout, should be the acronym sheet. So if you have any questions, please reference there. But if you have any questions, feel free to go ahead and ask the question. Feel free to ask it as we go. I will generally answer them as we get to polling questions, but sometimes I'm paying attention a little more often. So this is me. This is me and my family. As you can see, this is my whole family here. My wife of now 25 years, my 3 girls, with our newer addition, our Annabelle, that we've now had her. We adopted her 2 years ago. And then this is the daughter that is now going to school in Phoenix. And as you can see, we love to travel. This is the most recent picture here in the lower right-hand corner. That is from the northwestern coast of Puerto Rico on a very beautiful day that we had that day. But here's about me. Went to school at University of South Florida for both my bachelor's and master's. After spending 16 years with others across the central Florida, from Tampa all the way over here till Melbourne, decided to go out on my own. This past tax season was my 26th. It's hard to believe I've been doing it that long, but when you can say you've been married 25 years, doing something for 26, you have a 23-year-old daughter, any of those things makes you feel start feeling older. So I love to teach. I teach the annual tax update, and I teach tax resolution courses. Been already to Minneapolis, Indianapolis this year, as well as LA. Probably will also be in Richmond, Virginia, and Atlanta later this year. And I have my practice with a staff of, now there's 5 of us here, and I write a monthly column for my local paper, as well as I have a book. So let's go ahead and get started. So we're here to talk about statute of limitations. We're going to talk about what they are, how they affect things you need to be aware of and concerned when you're dealing with statute of limitations, because they can work for you and they can work against you depending on what the statute of limitations clock is. And then we need to be aware of certain events that start and stop the clock, or maybe even never started it at all. So we just need to make sure what happens then and what happens when that clock runs out. So first, let's just talk in general about what a statute of limitation is. Now, according to the IRM being the Internal Revenue Manual, a statute of limitations is a time of period established by law to review, analyze, and resolve taxpayer and/or IRS tax-related issues. Okay, so it's important to know that when it comes to the statute of limitations, it's the period that gives the IRS to assess, give refunds, allow credits, and collect taxes within a certain time limit. Okay, and we're more specifically concerned about these 3 here at the bottom. There's the assessment, the refund, and the collection. Okay, and they're called statute expiration dates. And so we do the assessment statute expiration date for ASED, the refund statute expiration date for RSED, and the collection statute expiration date for CSED. Those are the acronyms that we use here. Okay. Now, it's important for you guys to know that there are employees who do watch the statutes. Now, just like anything else, it only gets watched if it gets moved to the top of the pile for some reason. Typically, again, they're going to go for the bigger dollar items, or people who are repeat offenders, or anything of that nature. You know, like if you're dealing with an exam, they're going to be more pertinent to pay attention to the ASED period, which I'll talk about here in just a few minutes. But it's important to note that there are people there that do try to protect the statute and ultimately collect or assess the amount of tax that is allowable. Now, the people in the statute program, their job is to minimize barred assessments so that they can actually assess a liability. We'll talk about that. They're going to provide alerts to the campus and field personnel. So that's the campus, the main campuses, or the revenue officers, revenue agents, so that things are being done and done timely. They provide maximum feedback to the guidelines, and they coordinate any open controls. So that brings us to our first polling question, and didn't update this, so I'm going to start with, this is just a little test on some other types of questions. Any questions at this point in time? Again, feel free to ask your questions as we go. Anything that's particularly case specific, we can't answer, but we can give you some general guidance in regards to certain things. Okay, so if you guys would answer it, even if you're not here for continuing education, because once we get to 100%, we can go ahead and move on. Otherwise, I will close the poll in 1 minute. We got 1 or 2 more of you that need to vote. Oh, there we go. We got to 100%. Thank you, guys. So close that poll. So let's talk about the assessment statute expiration date, the ASED. This is the 3-year period after the due date of the return, or 3 years after the return was actually filed, whichever is later. Now, for the most part, the average taxpayer is going to be dealing with the former versus the latter. Okay, they're going to file the return, and they're going to file their return timely. So whether they file it by April 15th or they extend it till October, then you have 3 years after the due date of the return. So that's what drives. That allows the IRS uh, to 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 review, exam, or ultimately assess anything. So this is where they can do they can do CP 2000 notices, they can do notice corrections, they can actually do a correspondence exam, they can do an actual IRS, a full-blown IRS exam. As long as it's done within this 3-year period, they can do it unless there's some other extenuating circumstances, which we'll talk about here in a minute. But they can do anything during that period. Okay. Now, if you're dealing with a lot more of collections cases, you're probably going to fall under the latter. So if the return was filed, 5 years after the original due date, then it starts running 3 years after the return was filed. So that is going to be, obviously it's a detriment, and not that they can't audit those returns, and it's just more likely that they typically won't be unless we're talking about huge dollars on a tax return. Now, please note that this period applies to most tax returns. Okay, and the one that really kind of needs to be brought out more to make it more apparent is that when it comes to employment tax returns, or more specifically the 941s. We all know that 941s are due quarterly as the year goes on. So the first quarter is due by the end of April, second quarter is due by the end of July, and so on and so forth. But please note that the start date for the 3-year statute of limitations on forms 941 starts on April 15th of the year following the year filing. So here we are in 2019, and 2018 returns, we've completed all 4 of those for the year of 2018. That statute of limitations did not start until April 15th of this year. Okay, so that all 4 quarters. So technically, if you want to look at it, the statute of limitation is open for all 4 quarters, and the first quarter for quite a bit longer. I mean, it's almost a whole full year extra that is technically open for additional assessments, penalties, and everything associated with that. So what ultimately happens with an unfiled tax return? It should hopefully go without saying that an unfiled tax return has no statute of limitations, that without the return being filed, this 3-year period is not running, because notice how it says 3 years after the due date of the return, or 3 years after the return was actually filed. So the first one is if it's timely filed, the latter one is if it's filed later, after the original due date. Okay? Now, what actually starts the clock? So this is what's important here. What is deemed as obviously here a return filing? Okay, so in general it says here a document is filed on the date that is received at the place designated for filing by the service, this being the IRS. The taxpayer is not considered to have filed a valid return unless filed a tax return unless they filed a valid return. So then that brings the question is, what is a valid return? Okay, well, first, let's just talk about the filing date. Now, we all know that in general, it's the latest postmark on the envelope or latest date from a private delivery service. Now, notice that it says the postmark of the return. So that's why we recommend sending certified mail to prove when you actually mailed it that it was before the date, because if you send it if you mailed it on April 15th, it's obviously not going to get there on April 15th. They will mark and post probably the 18th, 19th. The mail has actually been running pretty good lately, because I sent a payment once recently, and I think it was posted within like 4 days to the IRS. Okay, now just note that here, that when on their end, when the envelope or label is not attached, they use the postmark date that's stamped or handwritten, because when mail is received at the IRS, you guys have all seen those like library stamp date stamps. When you've probably seen that, was it Capital One commercial where the person is doing the stamping and making a lot of noise in the library. When they stamp that, they stamp the document on the top of that's the date that it's received somewhere on that document. So that is sometimes will be the driving date. So then we need to talk about what a valid return is. Now, a valid return is all of these things. So there must be sufficient data to calculate the tax liability. The document must claim to be a return. And it must include the name, address, and the taxpayer identification number. So it must say that it's a tax return. It must be an honest and reasonable attempt to satisfy the requirements of the tax law, and it must be executed under penalties of perjury, which includes a valid signature. Or in the case of an e-file, it has the PIN number when the return is filed. Now, when you look at that, this criteria came up because of the Beard case. It was a tax court case, and later affirmed by the Sixth Circuit that this is what makes a valid return. So at the end of the day, based on what this is saying, I don't know what the facts and the circumstances in the Beard case is, but you could actually file this on a regular piece of paper on the back of a napkin. As long as it meets all of these requirements, you could actually file a return and have it be that way. And you'll see, and you've ever noticed, you've probably ever had a client that files a return, but they forget to sign it, that those returns will be sent back. And then sometimes you have challenges that sometimes by the time that comes back, the taxpayer or spouse dies, then you have some extra issues and notifications and other things to do to make sure you get that filed. Okay, but unsigned returns are not valid returns. Okay, so that's why if they send them back, it's as if it never happened. It was never filed. Now, other things to consider here is what happens with somebody who files an early tax return. We had one of our members in our membership group said she used to operate a Liberty tax office. I believe it was in Oklahoma, and with her, I believe now ex-husband. But she used to say that more than 50% of their returns that they filed at their Liberty tax was filed before Valentine's Day, which is mind-boggling to me, because if I could get 50% of my returns done by then, I would be super excited. But if you file a return on Valentine's Day, the 14th of February, then the due date is still hasn't come yet. So technically, the clock doesn't start running until the due date of the return. So in that example, you can say that they actually have an extra 2 months of time to assess. Now, we all know that based on today's technology and the staffing resources, that's nothing's going to happen in those extra 2 months in regards to that. So just be aware. So the statute of limitations starts on April 15th. Now, these are some things to be aware of when it comes to the ASED period. These are things that stop that clock. What that means is that 3-year period can become 3.5, 4 years, 5 years, or longer, depending on what's going on. So, for example, filing a false return, that even though they filed a return, the statute of limitations never run. No return filing, and a substitute for return. Because remember, a substitute return is only for assessment purposes, and we'll talk more about that as it relates to the collection statute expiration date. But the SFR is not a return for the ASED purposes. Okay, so I want to make sure that we're clear on that. It is only something the IRS does to create an assessment so they can take collections action. It has nothing to do with the assessment statute expiration date. If they file an SFR, if you don't replace it with a return, an actual return filing, then that statute of limitation is open. Now, these others, the 25% emission of income causes the statute of limitations to expand out to 6 years. Bankruptcy, taxpayer outside the U.S., and offering compromise, doubt as to liability, causes this period to expand to stop the assessment statute expiration date. And lastly, you can agree to extend the statute of limitations. So that's also called a waiver. And if you're going to have that in the case where you're dealing with an exam, and when you're dealing with a revenue agent, they will, a lot of times, if there's generally 6 months to a year, they will ask you to expand that out to at least another 12 months. Sometimes they'll ask you to either go to 18 months to a year, or actually 2 years. I was at the IRS Tax Forum this past week and sat in on an exam appeals session, and the gentleman there, who was the higher up in the Tampa office, actually said that they won't even talk to you if there's not at least 12 months on the statute. I've always been told it was at least 6 months, because it takes that long to get through appeals. But this guy said they won't even talk to you if there's not at least 12 months. So and that's just because you don't have you won't have the opportunity to get through the system, and they want to have some cushion, obviously, on their end. So, why would you extend that? Well, the question becomes is when they come in and they do an exam, they are, you're getting through all the documentation, and if you don't extend it, then a lot of times we'll put the brakes on the case. They'll sometimes they'll disallow things that you've been talking with them about. They'll make an assessment, and when they do that, it's not something you're going to like. So typically, it's better to play ball and extend it by doing a waiver, extending the waiver and adding that more time to it. Now, obviously, it can be a double-edged sword, but you only deal with the returns in which that you're dealing with, and it's just better in your best interest to do that. Okay. Which brings us to let's talk about credits and payments. Now, it's important to know that credits and payments have a limited life, and it's not uncommon. The most common ones that we're going to have are dealing with the withholding tax, federal tax deposits, estimated tax payments, extension payments. Those are only good for a certain period of time, and ultimately, what happens is that this period, known as the RSED, this period runs from 3 years from the original due date, not the extended due date. And so it's important to know that this is where in March, the IRS is always sending out that email that usually it's somewhere between $1 billion and $2 billion of refunds go unclaimed, and they try to get people to file those returns. So we're now coming up on 2016 returns coming this April 15th. All of these things will go by the wayside and they will not get them. So if they apply in regards to their return and it creates a refund, whether it's just by reducing their tax or by reducing their actual tax liability as a payment, they will not get it if they don't file it by April 15th of 3 years when the original return was due. Okay, so, and for payment purposes, the extension payments, federal withholding advance payments, so whether estimated tax payments or federal tax deposits, are considered paid as of the due date of the return or April 15th of the following year. okay? Overpayments are applied to the next year and are treated as estimated payments to the next year. So even if if your client made an extension payment of, let me back up. Let's say they made an estimated tax payment on April 15th of last year for their 2018 returns. They did it in April, June, September, and January. All of those payments are considered as being paid as of April 15th for the RSED purposes, or this collections purposes, okay? Now, here's what the RSED actually states. Okay, the original delinquent returns are received after the required and prescribed due date or extended due date, and it does not contain a TC 150, then that if they're originally within 2 years and 9 months or older, that it must be cleared by the statute function. Okay, because here it says original delinquent returns received more than 3 years after the due date may have refund statute expiration implications, which means that you file a return, they're not going to get their refund. When you're dealing with this on the collection side of things, this really can suck, because I had one last year where I'll tell you the story here, and there was a saving grace. But what happened here is she had 4 years of outstanding returns. 3 were open, 1 was not. She had 1 year with a refund. Guess what year that refund was? Yes, you are correct. It was the oldest one. So in this case, this was last year's returns we were doing. So that was a 14 return. But what I did on that return was I took that refund and I applied it to 2015. Now, are they required to? Are they allowed to? Yes, they can, but they can also tell me to go somewhere else, because they didn't have to issue that, but they allowed that credit on the 15 return on the tax that she owed for that year, which was a nice thing. Okay, which brings us to our polling question, and we're going to go with one of Jason's goofy ones here. So if you would go ahead and answer that, and I'll answer some questions. Okay, so what we have here, Christine says, so 941 is due, well, it's originally due July 1st, it's late after July 31st, and then the statute of limitations starts on April 15th of the next year. So in your example, she said if it's due 6/30/18, then the statute of limitation starts on 4/15 of 19, and that is correct. Sarah, on the slide where the 2 years, 9 months, that means that if you're with your client or filing a return that is filed within 2 years, 9 months, that means the IRS, somebody in the IRS is supposed to be looking at that to approve that refund, because they have a very short statute of limitations in which to issue that refund. Now, remember, they're just now filing it, so there's still 3 years to go back and assess it. So just be aware of that. And Jacqueline, just on the 1040, there's the area where it says to your overpayment, do you want it refunded or do you want it to apply to next year? Okay, so all I did was on the 2014 return for my client at that point, all I did was applied her overpayment to next year as opposed to having it refunded. Because if we'd had it refunded, she wouldn't have gotten it at all. Okay, so at least with that, applying it, I gave her at least a fighting chance, which managed to work in this particular case. Okay, so Sarah says my client needs to get me the info for the 2016 1040 really quickly. Yeah, I mean, if you look at it right now, Sarah, you've got figured that April 15th of 2020 is when the 2016 returns run out if they are due refunds. Okay, so if they don't file their refund return by that date, they're not going to get it. You know, I had a client that recently I helped them through a correspondence exam, and then I mended a prior year return which was still open, and sent them the return. Of course, this just happens to be it's a military family living, I think they were living in Okinawa, and sent them the return and told them they needed to get this done and filed, and it was like early March, and apparently they sat around on it, and then she contacts me, I don't know if it was late April or early May, and says, where do I need to mail that return? And I'm like, you don't now. So you just, there was nothing I could do about it. So they just need to be aware of that. And yes, Sarah, so if your client has a refund coming due, then they need to make sure that that they get that return done for 16. Now, if you have one for 15 and you also have a 16 return with a liability, then you can try to have the 15 return applied like I did in the other one. Okay. So guys, thank you for voting. We got to 100% on polling question 2. So that brings us to talking about the CSED. Now, the CSED here, as you can see, is the collection statute expiration date. The collection statute expiration date is the 10-year period from when the IRS makes an assessment. So under Code Section 6502, it's the one that provides the length of the period and set at 10 years. So the collection statute expiration ends the government's right to pursue collection of a liability. So ultimately what that means is once that 10-year period runs, then the IRS can't do anything any further. The IRS, Treasury, or any other part of the government cannot do anything further unless there are other extenuating circumstances. Now, normally, as long as there's nothing that causes any issues or problems for that clock, then it starts. So if it were, say, today, August 19th of 19, and you were to count 10 years in advance from here, so that take it to August 19th of 2029, if you happen to get past that period of time and there's still a liability outstanding, which includes penalties and interest, then it just falls off. What the IRS does is they move it into what's called the uncollectible status, and they can't come after it anymore. Okay. Now, when you look at transcripts, what you'll usually see is this TC code, transcript code 150, and the code 150 is an assessment. And if you look at in the Internal Revenue Manual in this section here, there are many TC codes. Most of them are penalties. Okay, so typically a tax is a tax, and that will be assessed to the taxpayer. So ultimately, what creates that assessment? So when we're looking at all of these master files that the IRS has, this is what can create an assessment. An original return showing a liability, an amended return, if there are math errors on the return, a substitute for return, and I keep needing to update this slide. It's the automated substitute for return program was discontinued, not the substitute for return. They're still doing manual substitute for returns. It's just the automated computer generated ones they are no longer doing, and they terminated that almost 2 years ago now. It's hard to believe it's been that long. So claims for credit, refund, or abatement can, if these are being removed, can create an assessment. An audit or exam can create an assessment, which would include a correspondence exam or anything else of that nature. And if there's tax reconsideration. Now, ultimately, if there's showing a tax, that creates an assessment. What becomes more important is when there's a liability and there's obviously not enough payments or credits to get rid of that liability, and it shows an actual tax due. Okay, now here is where the ASED and the CSED correspond, because the IRS can only do any of these things or allow any of these things if the assessment statute expiration date is open. So that 3-year period that we just talked about before, the ASED period. So if that period is open, then the IRS can cause an additional assessment there. Okay. Now, when it comes to the CSED, just like there is with the ASED, there is a waiver period. And just suffice it to say, because I'll talk about this a little bit more here, but typically the waiver is usually only done in regards to partial payment installment agreements. And in a partial payment installment agreement, as you can understand, that I've had cases where people have owed, I don't know, $50,000, $60,000. I got one where he owed $110,000 and his payment was $250 a month. At $250 a month, there's no way he's going to pay $110,000, even if he had the full 10-year statute of limitations. He would not full pay that. They can ask you to extend that period, and we'll talk about that here in a few minutes as to why would they ask you to do that and why would you do that. Okay. So here are some examples. This is pulled out from the Internal Revenue Manual of some of the various things that causes the 10-year statute expiration date to be extended. Okay, and we'll go through and talk through some of these. I think I will cover, we'll cover all of these or most all of these. Okay, the one, yeah. So here are some of the more detailed ones here. Bankruptcy. Well, bankruptcy should hopefully go without saying, because at the end of the day, what is the IRS? They are the world's largest creditor. And what can a creditor not do in bankruptcy? And that is take collection action. So when they are in bankruptcy, this is one of those things that says, well, if we can't go after you, then that stops the 10-year clock for that period of what do you call it? The period that we have to collect. So here under the bankruptcy code, or under for the CSED rules, what happens here is it's the period that the IRS is prohibited by reason of collecting on the case plus 6 months. So if it takes 6 months to get through bankruptcy to get to that discharge, then you are now adding a full year to the CSED. So you can understand that now, instead of it being 10 years, technically it's 11 from the original due date. So this is one of those areas where it's important to know that from a counseling perspective, especially if you're talking to somebody and saying, hey, your CSED period's about to run out, you might want to wait on filing that bankruptcy and see if they can get past it. It just depends on what it is that you're looking at. Now, another condition that the IRS doesn't allow you to do is if you are in some kind of litigation, whether you are the plaintiff or defendant. That is a question on the Form 433, on all the forms. Are you in some kind of current litigation? Because as you can understand, that if they are in some litigation, again, whether the plaintiff or defendant, if they're the plaintiff, then there's a possibility that they can receive money. If they're the defendant, then they could probably pay money. And either event can cause and affect their ability to pay. So the IRS basically says that the period is stopped, or in the legal sense, the term is called tolling. It's a tolling event, and so that tolling event is for the period that they can't collect, that you are in legal action. Okay, so another one where it can cause in litigation also includes going to tax court. If you've ever looked at a transcript and you're looking at events that cause the CSED, or if you use a tool like Canopy or Pitbull or Tax Help software where they calculate the CSED period for you, and sometimes you'll see it's like I've seen them as long as 600, 900, 1,000 days. And a lot of times that will have to do sometimes with bankruptcy, going to tax court. Those are usually probably the biggest two that I've generally seen. Okay. Any questions on any of those? Feel free to go ahead and ask them. Now, the first item. This is the item that it's important to know that, remember how I said that there can be that waiver that the IRS can ask you to extend the 10-year period, and why on God's green earth would you do that? The first item there is why. Because the IRS can actually sue your client in court, no different than if they were going to, a credit card company was going to sue them. They're suing them to get a judgment, and when they do that, this is, I believe, one of those things that's dependent on state law, but they can actually add or restart that clock and make it 20 years. It restarts the clock. It adds, if you had 2 years left on it, they reduce it to judgment. That's what we call it. They reduce it to judgment. Then it's a new 20-year clock. And so if you can exchange that by extending it for a year or two or more, then doing it for 20 years, and I'll go into further deep detail as we talk about this with another item here in a few minutes. Now, when it comes to the CDP process, so this is on the collection side. So when you go to a CDP appeals process, okay, so this is collection due process, not the exam side, this is collection side. If you go to an appeal for a lien, a rejected offer, a rejected CNC or installment agreement, and you go to appeals for any of these things, that is a clock stopper. Okay, so it's a period from the period you file to it becomes final or they withdraw. Now, just so that you know, when you go to appeals, so the time you file, so if you file it, let's say you filed it July 1st, and you go and you get a notice of determination from the appeals officer on December 1st. There's a 30-day period that has to run, because that is your period in which you can then still take it to tax court if you want to. So once that 30-day period runs, then that is when the CDP clock stops. So if you did it from July 1, December 1, add 30 days, takes it to December 31. So you just added 6 months to the CSED clock by filing the appeal. And if you later decide to withdraw, like say you did it in 3 months, you withdrew it for whatever reason, then it's still extended for a 3-month period. So it's very important that you understand and know, because I'm facing that right now with a client, that she's got till May of next year, and about $20,000 of her liability is going to fall off. So it's important to know that when you file an appeal, it's important to be aware of how much time is left on that clock. Okay, which then brings us to an offer in compromise. Now, an offer in compromise, from the minute that your offer is filed, and so that it is considered pending, or 30 days following a rejection of the offer, and then if you go to appeal it, then you've got that extra time added there. Okay, so so the CSED extends the period of time while an installment remains unpaid and for 1 additional year after are eliminated. Okay, so all that means is you file the offer in compromise, and if it's accepted, then it ends once it's accepted. Now, please note that it's accepted when all of the offer terms are met. That means that you have to make all of the payments, depending on whether you did the lump sum or the periodic payment offer for the offer. So once you've done that, then the clock stops. Now, if it's been accepted, honestly, you probably don't care. The only time that really becomes pertinent is if the client blows the offer. Because remember that one of the terms in regards to an offer in compromise is that they must be on the straight and narrow for the next 5 years, filing their returns on time and not adding any additional liability. And if they blow that, then now this becomes pertinent. So it's important to understand what stops that clock. Now, doing the collections waiver, doing the reducing it to judgment, this is where this comes into play. Now, there are two things that are going on. First, let's talk about the general installment agreement. Please note that anytime you enter a client into an installment agreement, generally there is a minimum of 30 days that is added to the tolling period for the collection statute expiration date, and it's 30 days following the rejection, 30 days following a termination, and then obviously you add any appeal of that can extend it as well. So it's not uncommon that if you see somebody with a multiple of 30 days for their tolling statute, that generally means that they've entered or gotten out of an installment agreement a few times. So they're what we call a boomerang client. Now, when it comes to the partial pay, same rules apply here, but the IRS can ask you to extend the statute of limitations, basically no more than 5 years or up to an additional year after that, so a total of 6 years. And here's an example of a situation in which typically that would happen. One is a home builder. Okay, when a home builder buys land, the value of the land is obviously not at its highest value until it's developed. So once they put in the infrastructure and start building houses, now it becomes worth more than just vacant land. And so if the period of time is going to run before they start this development, but that period of time is going to happen in that next 6-year period, then the IRS can ask that to happen so that they can at least collect something of the additional liability. Where again, why would you do that? Well, wouldn't you rather extend it 5 or 6 years versus having them reducing it to judgment to extend it to an additional 20, when they can definitely get that and then some? Okay, so that's why it's important to know and understand that. So I am going to put up the third polling question here. Let's do this. I'm going to come back to a couple of questions that have been asked. Samuel says, does bankruptcy always toll the CSED? Does filing an offer extend the CSED? So yes, bankruptcy always will toll the CSED, and offer and compromise will also toll the CSED for all of the periods that are open at that point in time. So that is important to know. Then Christine said, so would the ASED be best determined from an IRS record of account on the tax from the taxpayer's transcripts? Yes, Christine, you can. You should always be looking at the transcripts and look at the codings and do your calculations, because even if you use a tool like Canopy, Pitbull, Tax Help software, they're not infallible, they're not perfect. They are basing certain things based on how they have been programmed to do the codes. And if you ever have any doubts, you can call the IRS and ask for the tax mod A. That will give you the CSED period. I don't know if that also gives you the ASED period, but you need to know when that clock is obviously going to run, when it stopped, what started it, what events stopped it, if any. Okay. And I have one more one that's collected in conjunction with the ASED CSED in a minute, related to payroll taxes. So I'm going to close the polling question here in 5, 4, 3, 2, 1, gone. Okay. So here we come up on one of the final events that cause a tolling event. At least one of the major ones, in which this is the taxpayer living outside the U.S. So if they lived outside the U.S. for a continuous period of at least 6 months, then that is a period that will toll the statute of limitations. So if the client shows up and they talk to you and they say, oh, hey, I'm going to go live in Thailand for the next 10 years while I ride out this statute of limitations, so that they can't come out and collect on me, then you can say, well, you can go to Timeland, you can be there for 10 years, but it'll be here when you get back, and not one day is going to run on that. Because remember, the IRS is connected to all the parts of the government, so they can easily ask people at the Secretary of State's office to determine when, based on the passport control, when somebody entered and exited the country. So it's important to know that if you find somebody who is having those kinds of issues, that or they're that kind of person that likes to travel a lot, they need to be aware of that this is something that's going to stop them. Now, if they're generally just going out of the country for trips here and there, not a big deal. It's when they're for a continuous period. So if they're an expatriate or something of that nature, this is something they need to be aware of. Okay. Now, lastly, but certainly not leastly, let's talk about the substitute for return. And let's talk about how this relates to the CSED period. Now remember, the substitute for return, SFR, is not a return for the ASED period. It is a return for assessment purposes and collections only. So it starts that 10-year clock. And basically the gist of what this slide says is this. I'm going to give it to you by example. If the IRS files a substitute for return, and that substitute for return says it's $10,000, that starts the 10-year clock. Now, a year goes down and you go and file an actual return, and let's say it shows that they owe $15,000. What happens is that a year later you file that return and you're replacing that substitute for return. Now, the original $10,000 has been already running for 1 year, so there's 9 years left. The additional 5 now has its own clock. So it's going to start today and run for 10 years from now. And let's say a year later, the IRS decides they want to audit that return, and now they say instead of you owing 15, it's now 20. So what happens is the original 10 has now been running for 2 years. There's 8 years left. The original return you filed with the additional 5,000 is now running for another year and has 9 years left, and now there's an additional 5 that has its own 10-year clock. So the important piece there that I want you to know is that the clock, there can be multiple clocks in one particular year. Now, normally you wouldn't file a return if it's going to increase the liability unless you're really concerned with wanting to get the 3-year ASED clock running. Generally, now let's look at it on the flip side. Let's just say that they file a substitute for return and that they say it owes 15,000. Well, you file an original return to replace that, and it's now 10,000. That doesn't restart the clock, and now the 10,000 is still running, has been running for a year. So a year later, after the substitute for return, you file an original return, and it shows a liability that's less than what the IRS originally did, which is normally going to be the instance where you're going to file that return. You're going to reduce it to 10, and that 10 has already been running for 1 year. And if for some reason they go and do an exam, or if you file an amended return and you do that a year later, and in this exam they say, oh, hey, we owe you money that you missed this, that, and the other, and let's say that now that liability is 5,000, it's already been, that 5,000 has now been running for 2 years. It does not restart the clock. Okay, so it's important to know that and understand that. Now, one final piece that I want to add here that shows a connection between the ASED and the CSED period, and that has to do with the trust fund recovery penalty. It's important for you to know that the trust fund recovery penalty period is the ASED period. So they can only assess an additional tax, so they can only assess the trust fund recovery penalty as long as the ASED period is open on those payroll returns. Now, more than likely, typically you're going to have people who are just now coming in, haven't filed payroll returns for a number of years, a number of quarters, and so you're now going to prepare those returns, and you're just now going to get that clock started, and the IRS can assess the trust fund recovery penalty to those individual or individuals. Now, here's an example of one that I happen to have, which was very nice. I had a bookkeeper that had been referring work to me, and he called me up and said, "Hey, Dan, can I talk to you about this particular situation?" He'd received this notice from a revenue officer that I'd been dealing with on another case, and she wanted to talk to him in regards to his outstanding tax liability. Well, he gave me all the details and showed me everything and said that he had a construction company that 10 years earlier, he had filed all the payroll returns. The business went out of business. The only thing that was left in it was a truck that he took, and it really wasn't worth that much. So the business is out of business. He'd filed all those returns. Not only that, but it was $180,000 worth of tax. And he had filed those returns, and here she is 10 years later wanting to try and collect on that. So what was really nice is after the conversation, I told him I would call her and take care of it. And I said, basically called her, left her a message, and in a nice way, I said, basically, go pound sand, you're not getting a dime from my client, because the business was out of business. There was nothing to collect there, and it was their liability. And B, she could not assess the trust fund recovery penalty because he filed all his returns on time, and that 3-year ASED period ran. So it did not matter what could happen to the business, because the business didn't exist. They can't collect from the business, and they didn't have any ability to assess the trust fund recovery penalty to him. Okay, so it's important that you know the connection a lot of times between the ASED and the CSED, because basically telling that IRS agent, basically I told her in a much nicer way, but go pound saying you're not getting a dime. And later I talked to her on the other case, and when I was done, I said, oh, by the way, what did you do with that? She said, I just wrote it off, and she closed the case. So that was nice that my client got out of having to pay $180,000, because he was really nervous and scared in regards to that. Okay, so I'm going to put up the fourth polling question, and we'll make this one an easy one here. And I have a question here from Ben said. So $27,000 debt, C said on about 17 of the debt is March 2020. Client has no assets, will be mostly living on Social Security, so full amount is uncollectible. $6,000 new debt from tax year 2018. Client will be able to pay 2018 debt over the next 3 years. Currently on a payment plan for previous debt, but started prior to new 2018 debt. Current plan is to try to increase payment plan, wait for she said to process, then attempt to pay remaining debt over the next 5 years. Might it be better to do an OIC now to accomplish the same result during the CSED? Ben, you've got a very specific question here, and I really can't answer that on this webinar here. But if I'm following you correctly, I think your client sounds like the CSED is about to run into March. I wouldn't do anything if the IRS isn't knocking on the door, they aren't asking for anything. I would just try to see if you can skate by past March 2020, where that 27 or the 17,000 of the debt is going to go run by. And then you can deal with the 2018 debt and try and get them into a payment plan that's going to work for them, especially living on Social Security. So I would not file an offer. I would not file I would not change the installment agreement, because all of those things are going to add time to your CSED, and that's something that's the general advice I would probably give here, if that's kind of what you're getting at. Sam says, if trust fund penalty always applied to a person or assessed under the business only. For Samuel, the trust fund recovery penalty is assessed to the individual that's deemed willful and responsible. That's a whole separate course that we cover. And then he said, in considering the ASED and the business is closed. So yeah, so it's the business owes the payroll taxes. The person who's responsible and willful for not paying those taxes can be a person or persons, because there can be multiple people and they don't have to be just owners. So this is where signers and other things can be a problem, but they can go after all of those people. Okay, so I'm going to close this polling question here in 5, 4, 3, 2, 1. Okay, so so that is the presentation. So It's important to be aware of your ASED periods, whether and being aware of the refunds or credits that they're about to lose. It's important to know your resolution options, how they are affected by the CSED period, know what starts and stops the clock. Hopefully you have a better understanding of all of that. And everything that I've talked to you about can be found in the Internal Revenue Manual in these two particular sections. Okay. Now,